Mr. Bean purchases equipment from Crankshaft for a price of $1 million. And that's regardless of whether we install or not. So now we have to decide if the total is $1 million, how are we going to allocate it between the two separate performance obligations, which involve the equipment and the install. We got it segregated, okay? And remember, this is $1 million, and they say this is 50,000. But we can't do that because you're only selling the thing for $1 million. So it's not possible to spread the $1,050,000. So what you have to do, you have to say for the sale of the equipment, we're going to take $1 million out of the total of $1,050,000 times the $1 million transaction price. And then the install is going to be only the $50,000 out of the $1,050,000 times the $1 million transaction. And when you do that math, you should get for the equipment $952,381. And for the install, it is $47,619. $47,619. Remember, this is the same as the proportional method that we did back in chapter 16, and we did it in 15, and you did it in 371 with respect to inventory purchases. So for, I think, question A, how should the transaction price of $1 million be allocated among the service obligations? That should say the performance obligations, in my opinion. But there you go, there they are. Those are the two amounts. Okay, now look at B. Prepare the journal entries for Crankshaft for this revenue arrangement on June 1 of 17 and September 30 of 17, assuming Crankshaft receives payment when the installation is completed. So now I don't remember, let's read what happened. Delivers the equipment on June 1. Okay, all right, so here we go. Then since they don't pay until the installation is complete, we would debit accounts receivable because they owe you. So debit accounts receivable, $1 million. Credit sales revenue for the sale of the equipment, the $952,381. And credit unearned installation revenues, $47,619.
Was sales revenue not earned?
No, you delivered the equipment, so the sales revenue is earned. That was just sales revenue. Only the installation is yet to be done. All right, now we got to immediately update cost of goods sold and inventory. So debit cost of goods sold and credit inventory, and that is what, 600, yeah, the cost of the equipment is $600,000. That's in the last bullet point. $600,000. Okay, now remember the installation of the equipment is complete on September 30 of 17, and they pay us today. So then the next date will be September 30 of 17. You would debit unearned installation revenues, credit installation revenues for the 47,619. And then what are you going to do when they pay you? Debit, cash, for how much? 1 million. Credit,
Accounts receivable.
accounts receivable, 1 million. That's exactly right. Now remember, we were discussing on Tuesday the idea that the installation takes a number of months. And we were discussing, should we say, take that 47,619, and if it's over 6 months and we do all the work evenly over 6 months, should we recognize 1/6 of it at the end of each month as we go? Or would you say, no, that's not legit, because if we quit halfway through, they're not gonna pay us any of that installation revenue. So my point is, you got to think it through. They're gonna tell us in here what to do. But in the real world, you're gonna have to think, would that be appropriate that we should recognize the revenue ratably, or should we wait until it's through? And the fact that they're not gonna pay you until the installation is 100% complete tells me you ought to put off recognizing that revenue until you actually get it.
So what if a company, any company stipulates that you have 50% payment due upon whatever date for the installation? Would you then, could you argue that you should span that down payment over the 6 months to install, or no? Cause you're working to install even though the obligation technically isn't complete.
The fact that progress payments, which is something we're gonna discuss later today, are required doesn't have anything to do with revenue recognition.
Sure.
The fact that they're fronting you some of the cost as you go should not impact whether we recognize revenue. What impacts whether we recognize revenue is whether we have satisfied an obligation to perform. So, no. All right, that was 13. You were supposed to do some homework for me. Did you do? You were supposed to do a problem or two.
Just one.
Problem 3 and 4, did you do them? Okay, well, before we get there, let's go to 26, I'm sorry, page 1039, exercise 26.
That text you said, yeah, hang on, let me go back to the bill.
Now remember, with warranties, what we recorded back in chapter 13 was an assurance type warranty, where we say if the thing becomes defective during the warranty period, we will repair it or replace it free of charge to you. That's an assurance warranty. And they're not buying that. We give them that when they buy the product, okay? Then there's the service type warranty. And if you've ever bought an electronic piece of electronic equipment, you have been urged to buy an extended warranty. So maybe it covers for a year itself, but you can extend it to 3 years or 4 years if you'll just pay $75. That you are paying for, but yet they're getting it over time, so that needs to be set up as a liability because we're paid up front for it, and then it needs to be recognized over time. Remember, under the assurance one, what we did is we debited warranty expense and we credited warranty liability, right? And then as we honored those obligations, we debited warranty liability and we credited either cash, accounts payable, wages payable, parts, etc. okay? Now that was the assurance warranty. Now we have a situation where somebody's gonna buy a warranty from us. So if they buy that warranty from us, then we're going to debit cash and credit unearned warranty revenue, right? They pay you $75, and that's gonna extend the warranty all the way to year 4. Year 1 is given to you when you buy the product. Years 2, 3, and 4, you gotta pay $75 for it. So when that transaction happens, in essence, you will debit cash for ever how much you sell the extended warranty for and credit unearned warranty revenue. Now look, we do not attempt to estimate what the costs are going to be in years 2, 3, and 4 for warranty expense the way we estimate it up here. Why do we not do that in the second case?
They're just trying to recognize revenue on this.
Okay, but why do we do, let's go back. Why do we do this in a assurance type of warranty situation? Why do we estimate the cost of honoring a warranty that is given to the customer just when they buy the product? Why do we debit warranty expense and create a warranty liability account?
Because that warranty cost is included in the cost of whatever you're purchasing.
Okay, I would agree with that, but I'm still digging for why do we do it?
You might have machines returned that aren't.
Say it again?
You might have machines or inventory that the warranty is on that's not functioning. They're recognizing that the liability up front.
Is it because we have to pay for it, like it's our cost?
Well, yes, but what I was hoping you would get to is to say matching principle. What does the matching principle say? That you must match expenses with the revenues that they relate to. When did you record the sale of the washing machine this year? Then you need to get the warranty expense related to honoring warranty cost in the same period when the related revenue is going to be recognized. That makes sense? So it's a matching principle. So now watch this. What are we going to do in year 2? At the end of year 2, now that's remember, year 1 is covered by the assurance type warranty. We've already accounted for that. Now we're at the end of year 2, so the first year of the extended warranty has happened. What journal entry, adjusting journal entry, should we make? Debit?
What is that?
Unearned warranty revenue for probably $25. And credit? Warranty revenue, $25. So see, look, now think about that. The revenue is being recognized in year 2, so any warranty cost that might have been $15 will also be recognized. Therefore, there's a matching of the warranty cost and the warranty revenue in that period. That's why we handle these two differently, because of the matching principle, or the matching concept. So look at exercise 26. On January 2nd of 17, Grando Company sells production equipment to Fargo Inc. for $50,000. Grando includes a 2-year assurance warranty service with the sale of all of its equipment. The customer receives and pays for the equipment on January 2 of 17. During 17, Grando incurs costs related to the warranties of $900. At December 31 of 17, Grando estimates that $650 of warranty costs will be incurred in the second year of the warranty. A, prepare the journal entry to record this transaction on January 2 of 17 and on December 31 of 17, assuming financial statements are prepared on December 31 of 17. Okay, so for part A, we would record the transaction on 1/2 of 17. What are you going to do? Debit,
Yeah.
cash, $50,000. Credit,
So the-
sales revenue, $50,000. Okay, now, we should also, in a separate journal entry, debit warranty expense and credit warranty liability. Okay. We would not know that we're going to incur $900 by the end of the year, but we would know that in the past, we have historically, warranty expense has been 3% of sales or 5% of sales. So the warranty expense is gonna be the 900 plus the 650, so 1550. Debit warranty expense, 1550. And credit warranty liability, 1550. Then, we gotta record the fact that we've already honored $900 of that. So what are you gonna do? Debit, warranty liability, $900. And credit, parts inventory / wages payable, $900. Okay, so now let me ask you something. What is the balance in your warranty expense account for 2017?
1550.
1550. What is the balance in your warranty liability account at the end of 2017?
650.
650. So you've matched the expense, the 1550, against the revenues of $50,000, so they're matched in the current year. And you've created the liability for the fact that you think you're gonna have to pay some next year, in the second year of the warranty. Okay, B says, repeat the requirements for A, but assume that in addition to the assurance warranty, Grando sells an extended warranty, a service type warranty, for an additional 2 years at 2019 and 2020, that will cover 2019 and 2020 for $800. So let's repeat it. So for part B, January 2nd of 17, what are you gonna do? Debit?
Yeah.
Cash. How much?
50,800.
$50,800. Credit, sales revenue for $50,000. Credit, unearned warranty revenue, $800. Okay, then we still got to record the debit to warranty expense for $1,550. And credit warranty liability for $1,550. Then debit warranty liability for $900. And credit parts inventory / wages payable, $900. Okay, so are you with me? We sell the thing on January 1 of 17. And we include with it a 2-year warranty. So for 17 and 18, it is covered. Now what happens is we sell them an extended warranty. That kicks in 2019 and all of 2020. They asked us to just prepare the journal entries for the year 2017. But if they were deep thinkers, they would have said, what adjusting entry should the company prepare on December 31st of 19? What should the company do? Debit unearned warranty revenue. How much?
400.
400. And credit warranty revenue. It's time to recognize it. That's why you're debiting unearned, so that you can recognize the warranty revenue now.
That would be 1/1 of 19.
No, December 31 of 19. You don't earn it on the first day of the year, you've earned it 1/2 of it by the end of that year. Okay. Let's look at 27. Selic Inc. manufactures and sells computers that include an assurance type warranty for the first 90 days. That's really standing behind your product, isn't it, for 90 whole days. Selic offers an optional extended coverage plan that will repair or replace any defective part for 3 years from the expiration of the 90-day warranty. Because the optional extended coverage is sold separately, Selic determines that the 3 years of extended warranty represents a separate performance obligation. Well, duh. The total transaction price for the sale of the computer and the extended warranty is $3,600 on October 1 of 17. And Selic determines that the standalone selling price of each is $3,200 and $400 respectively. Well, doesn't that work out just perfectly? The whole thing is $3,600, and they say the standalone selling price of the machine is $3,200 and the warranty standalone is $400. So great, that works out. We don't even have to go through the math. It's already works out. Further, Selic estimates, based on historical experience, it will incur $200 of cost to repair the defects that arise within the 90-day period for the assurance type warranty. The cost of the equipment is $1,440. Assume that $200 in cost to repair our defects in the computers occurred on October the 25th of 17. Good gracious. A, prepare the journal entries to record the October transactions related to the sale of the computers. So, date your entry 10/1 of 17. What are you going to do? Debit?
Cash.
Cash. How much?
36,000.
3,600. Okay, what are you going to do next, Miss Toomey? Credit sales revenue. How much? 3,200. The sale of the machine is 3,200. Then what are you going to do? Credit unearned warranty revenue, $400. Okay, that's the first thing. Record the sale. Now let's update inventory. Debit, cost of goods sold, and credit inventory, $14.40. Okay, what's the next thing we need to do? Go ahead and recognize your estimate of the warranty expense. So debit warranty expense and credit warranty liability. And they say they will incur $200 in defects, so there you are, $200. Then it says, assume the $200 in cost to repair the defects occurred on October the 25th. So your next one should be dated 10/25. When you actually incur those $200 in cost, what should you do? Debit, warranty liability, and credit,
Parts inventory.
parts inventory / wages payable. It's interesting, we sold it on October 1, and on October 25th, they all go bad. 90-day warranty, and it only took 25 days for them to suck. Okay, B, briefly describe the accounting for the service type warranty after the 90-day assurance type warranty period ends. Okay, so then, just go ahead and date your next entry. When are you gonna date your next entry, Miss Toomey?
I don't know. Like 11.
When does the 90-day end? After the 90-day ends.
Alright, you sold it on 10/1, and at 12/31, that first assurance warranty expires. Then, so this will put us at 12/31 of 17, 18, 19, and 20. So when are you going to record your first adjusting entry related to the service type warranty? 12/31 of 18, that is right. And what are you going to do? Debit, unearned warranty revenue, and credit, warranty revenue. And this is $400 over 3 years, so what's that, $133? As close as we can get it. And then you would do it on December 31 of 19 and December 31 of 20, right? Questions? Does the way we account for this, does it make sense to you? All right. Okay, before I worked some completely different problems, you were supposed to do problems 3 and 4. And Miss Jones was sitting, lying in wait, ready to jump.
Well, I just went back and forth.
All right.
So,
Which problem are we on? 3 or 4? 4.
we had a contract.
So you're good with 3.
Well, for 3, we do the proportional method, right? And that's how you find out how much your earned, or the salary and the inflation and everything.
I think I did it right.
Okay, all right, so let's look at 4. I need to read it. Economy Appliance Company manufactures low price, no frills appliances that are in great demand for rental units. Pricing and cost information on Economy's main products are as follows. We have a refrigerator, a range, and a stackable washer dryer unit. The standalone selling price for them is $500, $560, and $700 respectively, and the cost are there in parentheses. Customers can contract to purchase either individually at the stated prices or a three-item bundle at a price of $1,800. Okay, well, let's go back and do the math. 500 plus 560 will be 1060 plus 7 is 1760. Well, boy, that's not giving us a deal, is it?
They're giving us an install though, too.
Yeah, I guess.
The bundle price includes delivery and installation. Economy also provides installation, but not a separate performance, so that's included in it anyway. So delivery is the only thing they're getting, cheap. Respond to the requirements related to the following independent revenue arrangements for economy. On A, on June 1 of 17, economy sold 100 washer dryer units without installation to LaPlante Rentals for $70,000. LaPlante is a newer customer and is unsure how the product will work in its older rental units. Economy offers a 60-day return privilege and estimates, based on prior experience with sales of this product, 4% of the units will be returned during the 60-day return period. Prepare the journal entries for the sale and related cost of goods sold on June 1 of 17. Okay, so what do you think? So date your entry, June 1 of 17. And you're gonna record your sale, so what are you going to do? Debit?
Accounts
I
receivable?
did accounts receivable.
Okay, yeah, since they can return some, I would probably do accounts receivable, 70,000, and credit sales revenue, 70,000. Then, you should also update cost of goods sold and inventory. So debit cost of goods sold and credit inventory. Now, we just sold 100 washer dryer units and they're at $400 a piece, so that's $40,000. Okay? Now, we should also do something with respect to the fact that we anticipate some of this stuff is going to be returned to us. So you should debit sales, returns, and allowances. Sales, returns, and allowances. And credit allowance for sales, returns, and allowances. All right, 4% of your 70,000, is that 2,800? So debit at 2,800 and credit 2,800. Okay, now, before we go any further, let's talk about something. What is that journal entry accomplishing?
Getting a better accounts receivable balance.
Okay, how? Did it credit accounts receivable?
No, that's a contra.
What is?
Allowance for sales returns, yeah, so.
The allowance for sales, returns, and allowances is a contra receivable. That's right. Just like the allowance for doubtful accounts. So we're saying our receivables, we think, are a little bit overstated because we expect them to send back as much as $2,800 of this merchandise. Okay? What does the debit to sales, returns, and allowances do, though?
It's a contra revenue, right?
That's a contra revenue account, so you're reducing revenues, your gross amount of revenues, by how much you expect to be returned to you. Okay, now, Good, that was good. Now let's talk about this. What if you're not in a position to estimate how much are gonna be returned to you? Returns are erratic. Sometimes it's 10% of sales, sometimes it's 1% of sales, sometimes it's 2% of sales, depending on whether this is a new product or something. What are our options then for revenue recognition?
You could take like a weighted average or something from like the past few years, maybe. Or just-
Okay, he says take a weighted average perhaps.
And you don't recognize the revenue until like they can't return it anymore.
And there you go. The most conservative example or approach would be to delay recognizing revenue until the return period is over. And then, if they haven't returned it, boom, it's sold. You may not be aware of this, but magazines in grocery stores and Walmart and places like that, magazines and those Globe, Enquirer, National Enquirer and all that crap, that's the way that is done. And they typically will bring the stuff and put it in stock, and then they come back the next week or the next month, depending on if it's a monthly publication, and get everything that's left, and then say, okay, now you have to pay us for the ones that sold. That's why they come up with these outlandish, Brad and Angelina have 4 heads, and we've got pictures, see inside page 25, because they were trying to get you to buy the stupid things. And the grocery store's like, we're not paying for that crap. Because we don't know if you're gonna sell any of them. And so they hold off, they say, we'll let you use the space, but we're not buying this. And that actually also happens in a lot of books too. Bookstores, because books, we don't know how this book's gonna sell. Maybe it'll be a great #1 seller and maybe it won't. But we're not gonna stock it up on our shelves and pay for it up front. So, we can either allow for it returns the way we just did with his 4% return, or if it's really, like if we have 50 and 60% returns, it might be more conservative, instead of allowing it 50 or 60%, it might be more conservative to delay recognition of all revenues until the return period is over, and then recognize whatever is left. All right. Let's go to B. B says, Yellow Card Property Managers operates upscale student apartment buildings. On May 1 of 17, Economy signs a contract with Yellow Card for 300 appliance bundles. And remember, those are $1,800 a piece, to be delivered and installed in one of its new buildings. Yellow Card pays 20% cash at contract signing, and will pay the balance upon installation no later than August 1 of 17. Prepare journal entries for Economy on May 1 of 17 and August 1 of 17 when all the appliances are installed. Okay, is that the last part? Nope, got more to go. All right, so first thing, you need to date your entry, May 1 of 17. And we're gonna debit cash, and also debit accounts receivable. And credit sales revenue. Okay, if they are buying 300 bundles at $1,800 a piece, what does that work out to? $540,000. Okay? So that is the sales revenue, $540,000.
Are we recognizing that revenue? Because we have to pay the balance upon installation, so we still have part of
Nope.
our obligation.
Yeah.
We have to pay, we're being paid.
Right.
We're the one that's selling,
Right.
okay?
So I'm asking if we're recognizing the full amount of sales revenue, because we still have to deliver and install these things.
Cause I didn't until August.
Yeah,
Well, Doesn't it say,
It says they pay 20% cash.
okay,
I recognize the 20.
I recognize the 20 as cash, unearned sales revenue,
Installations, no, there isn't.
and then on. This revenue principle's messing me up, man.
Okay.
That's what, I recognize 20%.
well, it doesn't say we delivered. It says to be delivered and installed, but I'm looking at the solution and they tell us to record it.
Well, it says you don't.
Well, you
install
told
it.
us all
it
that
just
day
says,
now.
What?
it just says you pay no later than August
Well,
1st.
what, the paying doesn't have anything to do with when the revenue is recognized. You do remember that you debit accounts receivable and credit sales revenue, and you haven't been paid, but you credit sales revenue.
But you haven't.
So the fact that you haven't been paid has nothing to do with whether or not you record it.
But you haven't installed them.
It's the,
Yeah.
it's you didn't finish your obligation till August.
Yes, that will pay the balance upon installation.
So that's
So
why.
crediting
that's
sales
what it's
revenue.
on.
Okay, then, sorry, so let's go back. Then let's debit cash for, what was it, 20% of what, 540?
109,000.
Yeah, 108.
108?
Yes, sir.
So debit cash, 108,000.
Okay.
And then credit unearned sales revenue. $108,000. Then date your entry August 1 of 17, the next entry, August 1 of 17, when all of the appliances are now installed. Okay, so we're going to debit cash for 540 minus the 108 is 432.
Got 40. Oh, never mind. I'm looking.
Debit unearned sales revenue 108. And credit sales revenue the total of 540,000.
So because the installation is not a separate performance obligation, we don't do
That's-
service revenue.
That's right. It says economy also provides installation, not a separate performance obligation. Okay, now we need to update inventory. Debit cost of goods sold and credit inventory 280,500 is correct. Let's take the 260 plus the 275 plus the 400 and multiply it times 300. And that is 280,500.
So where does that discrepancy come from in the solution manual?
What do you mean?
How, they wanted, you wanted to have cash and accounts receivable and then.
Because I was saying the sale has happened, but we haven't delivered them or installed them. So, because it says to be delivered, so we probably should not recognize the revenue related to the sale. And the installation is part of the integral transaction, is not a separate performance
that's a judgment
obligation. So
call.
we should not recognize the revenue until both are accomplished, delivery and installation.
Okay.
So, all right, let's look at C, see what it says. Uh-oh. Refer to the arrangement in Part B. That's the one we were just talking about. It would help Yellow Card secure lease agreements with students if the installation of the appliance bundles can be completed by July 1 of 17 instead of, what was the date, August 1? August 1. Yellow Card offers a 10% bonus payment if economy can complete installation by July 1 of 17. Okay, that's the variable consideration issue that we talked about on Tuesday. Economy estimates its chances of meeting the bonus deadline to be 90% based on the number of prior contracts of similar scale. Repeat the requirements in Part B, given this bonus provision, and then assume installation is completed by July 1 of 17. Okay, so you go back and record the first thing, May 1 of 17, the sale, debit, cash, and credit unearned sales revenue for the 108. Okay, now, date your next entry July 1 of 17, because now you've installed them and you get the extra, what is it? 10% bonus. So now we're going to debit what? Cash. Okay, now how much are you going to be paid? Overall, you were going to be paid how much, and then subtract what you've already received.
540 plus 54 is
540 is what you were going to get, plus.
for the contract, and then you got $54,000.
Okay,
bump for the-
so 540 is what you were supposed to get, and a 10%, so that's 594, and you've been paid 108.
108, yes, sir, 486.
Okay, so debit cash, 486,000. Debit unearned sales revenue, 108. And credit sales revenue for the total 594. 594. Questions?
You have to put a separate installation bonus entry.
No, because that's included in the revenue that we recognize. Okay, now look at D. Epic Rentals would like to take advantage of the bundle price for its 400 unit project. On February 1 of 17, Economy signs a contract with Epic for 400 bundles. Under the agreement, Economy will hold the appliance bundles in its warehouses until the new rental units are ready for installation. Epic pays 10% cash at contract signing. On April 1 of 17, Economy completes manufacture of the appliances in the Epic bundle order and places them in the warehouse. Economy and Epic have documented the warehouse arrangement and identified the units designed for, designated for Epic. The units are ready to ship, and Economy may not sell these units to other customers. Prepare the journal entries for Economy on February 1 of 17 and April 1 of 17. Okay, so date your first entry, February 1 of 17, and you're gonna debit cash and credit unearned sales revenue. Okay, it's 400 units at, is that the one that's 1,800 apiece? Okay, so I don't know how much that is.
720,000.
And then multiply that times 10%.
72.
So debit cash 72,000 and credit unearned service revenue 72,000.
Isn't it sales? Unearned sales revenue?
Yeah, what'd I say?
Service.
Yeah, unearned sales revenue. All right, and then what happens on April 1, we complete the manufacture. Okay, now, we should go ahead and recognize the revenue at this point because we're ready to go. We've segregated the inventory away from all of our other inventory. We can't sell it to anybody else by legal agreement. It's time for us to record the sale. So date that entry April 1 of 17. And you're going to debit accounts receivable because they owe you for the balance. You're going to debit unearned sales revenue, the 72,000 that we just recorded in the last transaction, and credit sales revenue. And wasn't it 720,000 was the total?
Yes, sir.
All right, so 720,000 minus the 72,000 would give you what for the debit to accounts receivable?
648.
648. So debit accounts receivable 648, debit unearned sales revenue 72, credit sales revenue the total of 720. Then debit cost of goods sold, and credit inventory. And again, our cost is 260 plus 275 plus 400 times
400.
400 units. What is that total? 374,000. So debit cost of goods sold and credit inventory, 374,000. All right.
So for the test, where are we gonna start tripping when it becomes cash versus accounts receivable? Cause I credit a number of these just cash as opposed to accounts receivable.
Well, I will tell you whether they received cash or not. I mean, in the case there where they say they pay 10% at contract signing, that
Right, yeah.
tells you it's a debit to cash.
Right.
But the other 90% goes to accounts receivable.
If you need to recognize the revenue now, if you don't need to recognize the revenue now, then that's all you do.
Cause that contract was good enough, that was my thing, I'm like, what if
It's-
the place burned down? I'm like, well, they must have that contract.
But, yeah, and the problem tells you, they own, they have legal title to it, they own it.
Yeah.
I can't sell them to anybody else, so it's theirs, I'm just housing them
Alright,
for them.
that's what I thought, I was like, they are, but
Can you just go over problem 3, letter D?
Yeah, that's what I was gonna ask for.
Problem 3,
Letter D.
D.
Jenkins and discounts.
Mm-hmm.
Mr. McCall.
All right, look at letter D. On October 1 of 17, Grill Master sold one of its super deluxe combination gas charcoal grills to a local builder. The builder plans to install it in one of its Parade of Homes houses. Grill Master accepted a 3-year, 0 interest-bearing note with a face amount of $5,324. The grill has an inventory cost of $2,700. An interest rate of 10% is an appropriate market rate of interest for this customer. Prepare the journal entries on October 1 of 17 and December 31 of 17. Well, what are you gonna do? They've given you a non-interest bearing note receivable. So you're going to debit notes receivable for the face value, which was
5,324.
$53.24. The fact that it's a 0 interest bearing note tells you what?
That you do the market rate of interest because when.
So, but that means it was issued at a discount. Okay? So the contra and we're gonna record the sale at the value of what we got, the note, or the value of what we gave the grill, whichever's more clearly evident. Here's a case where we have to go back to chapter 14 and determine the fair value of the note. So, 5324, there are no interest payments. But the lump sum is 5324 times some present value factor. So look at your present value of, which one are you gonna look at? Ordinary annuity or single sum? Single sum. Go across the top to 10%. and down the left column to where?
3.
Isn't it 3 years?
Mm-hmm.
What is that factor?
0.75,
0.75132. Therefore, that winds up being $4,000. So the sales transaction should be recorded for $4,000. So then the discount has to be the difference, $1,324. Are you with me? Remember when I told you back in chapter 14, this is going to keep coming up over and over and over again? And it's not going to say, remember, go back and calculate the present value of the cash flows. It's just going to assume you know it. So now what are you going to do on December 31 of 17?
Well, do we have to take off the goods sold?
Oh yeah, I'm sorry, we should have done that. Debit cost of goods sold and credit inventory, what was it, 27 even? Okay, and then we're going to, what are we going to do? Debit the discount. And what are we gonna credit? Interest revenue. How are you gonna calculate it? Carrying value times market rate times time. Carrying value is 4,000 times 10% times 3/12. $100? What? Are you with me? Questions? See how those same formulas keep coming back? Chapter 14, chapter 17, chapter 18. And I told you if you don't learn it, it's just gonna kill you. So there it is, yet again. All right. Now I'm going to take over and let's go to exercise 33. Okay. Now, let's talk about this in context. How long do you think it took somebody to build Shelby Hall?
4 years.
It was parts of 3 years. 10, 11, and 12, I think, or 11, 12, and 13. Parts of 3 years. Okay, so let's think about this. If we are the contractor who's building it, when should that contractor recognize the revenues associated with building that building for the University of South Alabama? Once the building is 100% complete and accepted?
No, when they complete that.
I guess it would depend on his contract.
They would get a draw, right? That's usually.
Okay, but does a draw have anything to do with revenue
It
recognition?
should be on completion,
No.
Beyond completion.
because like the practice
If
facility.
his contract stipulates that he gets through stage 1, however, whatever that is, and he completes that.
Well, okay, wait a minute, back up. Does the contract stipulate how he completes it?
I sure would. If the university,
All right, so the contract says it's half completed on December 31st of 18,
no,
and I haven't done a damn thing.
no, sir. See,
Then it ain't half
you
completed.
Let me finish. So you
What?
said it took, well, hang on now, hang on. You said it took 3 different years to complete it. It was completed in stages. So if I'm a contractor and I'm brokering a contract with the university and you tell me you want it done in 3 separate stages, I say, okay, well, here's the contract. This part's done at A.
No, I'm not gonna give you a contract to say I'm gonna build it in 3 separate stages. I'm gonna tell you I'm gonna build it, but I'm gonna sign the contract in September of 11.
Okay.
I'm gonna spend some time in 11 building it, I'm gonna spend some time in 12 building it, I'm gonna spend some time in 13 building it. The question is, when do I recognize the revenues related to building the building? Do I wait until the building is 100% complete and the university has accepted the keys? Or do I recognize some as I go along, as I make progress toward finishing the building? And what are the pros and cons? I mean, this is the kind of thing FASB people sit around and have to decide. And then they have to say, well, if we choose to wait until the very end, what are the implications?
Well, then you've had all these expenses for all these years that you've not matched, so
Ah,
that's.
so, all right, so she says you're incurring all these expenses in year 11, year 12, and year 13, but you haven't been able to recognize any revenues. Therefore, there's no matching, okay? Then what I say to that is, don't record those costs as expenses, put them on your balance sheet as an asset. So now what do you say?
Upon completion.
Huh?
Upon completion. Upon completion, whenever
Upon
the building's,
completion.
yeah, whenever the building's done.
Okay, so
being
look,
built.
all right, so what's the drawback of upon completion?
Well, you're missing potential revenues you could be booking in the previous years. You know, in 11, 12, and 13, if you don't book it until the end of 13,
Okay, so what's the implication of not recognizing the revenues in those years?
well,
In 11 and 12?
I mean, you just,
You're doing all.
What's gonna happen to the company's reported
Your
earnings?
revenue is increased, yeah.
but that's why you,
Gonna be a lot of fluctuations, right? Because we're gonna have some overhead costs that we have to book anyway, every year. But you got no revenues to recognize to offset it.
that's why there's a.
So you're gonna have a loss, big old profit. Loss, big old profit. Right? So the FASB said, well, okay. That's really not indicative. We want the financial statements to reflect progress that the company is making toward completing the contract. So they came up with the idea of percentage of completion. Now, listen now. In essence, they're gonna let you recognize revenues as you complete the building, as you incur cost and complete the construction of the building. Now, this could be ships down there at Austell. It could be highway or interstate. You know, somebody's resurfacing the interstate from here to Montgomery. How are they gonna recognize the revenue? Well, these are things that has to be decided. And one of the approaches that the FASB came up with was percentage of completion. They say it doesn't make sense to say that the building was 0% built in 11, 0% built in 12, and 100% built in 13. They said that's not reflective of actual activity. Now, the drawback is we might be recognizing more revenue than we're entitled to, right? Because we might think, I have no idea, but let's just say that building out there costs $30 million. And that's how much materials cost. and we paid somebody $35 million to build it, okay? Well, in a real contract, you, the builder, would determine what your estimate of the cost are. And you say, okay, I come up with $30 million. You don't tell the company that. You just say, okay, that's my cost. So here I'm gonna bid $35 million on it, because it's not gonna be worth it to me to make less than $5 million on this. Okay. What if it costs you $35 million to finish it? Then you make no profit, right? But are you gonna know that on day one?
No.
You're probably gonna know that in maybe late in year 2 and in year 3. So you might overstate earnings on the front end of that contract simply because you're not very good at estimating what your costs are going to be. Have you been in that building? Did you see any block walls like this? Did you?
No.
No. Did you see nice shiny floors, marble floors?
Oh, yeah.
Is that what we got?
No.
So when the university let that contract, the university had to be very specific in saying, what's gonna be the finished good, what's gonna look like in here? And we want 9, of course, it helps when Richard Shelby is the senator from the state of Alabama in the United States Senate, and he was the head of the Appropriations Committee. And that's why it happened to be named after him, because he got us a federal grant to build the building. I guarantee you, if it was the Abe Mitchell building, it would be cinder blocks, and you probably have a concrete floor to walk around on. But because it was the Richard Shelby building, it's got nice wood paneling and marble floors and lots of glass and big old chandeliers hanging from the ceiling and everything else. All that has to be spelled out. Because if not, the builders, you've all heard of builder grade? You know, they'll put carpet that if you walk on it one time, it looks like it's 100 years old. That's builder grade carpet that's just soft, next to nothing. Because if you don't specify, then you're gonna get the cheapest that you can get away with. Now, if we say percentage of completion, how are we likely to estimate percentage completion? I mean, I can look, I watched, I worked here when they were building that thing. And I'd come up and drive up here and I'd see the building, and sure enough, I could see when they first started, and then I could see it starting coming out of the ground. And then, I could tell they were making progress. I didn't know what percentage complete they were. So how are we, from an accounting perspective, going to go about determining how far along you are? What are some of our options?
Talk to management.
What? Cost management?
No, discuss with management about how far along they think they are.
Okay, so we'll talk to management and get their opinion. Okay, that's one way. Couldn't we also hire an engineering firm that does construction engineering? And they could come in and say, okay, they're 25% of the way through now. They're 33% of the way through now. And then we say, okay, now it's time to recognize those revenues, right? We could do that. Well, if we were to engage an outside, we are the accountants, engage an outside party, it's gonna cost us money. And so we're just gonna pass those costs along to our customer and say, you gotta pay for this. So the way we actually do it is we look at cost incurred to date divided by the latest estimate of total cost. So if the total costs are $30 million and you have incurred $20 million in cost to build the building, then you're 20 divided by 30, 2/3 of the way through, right? That makes sense?
In theory, yeah.
In theory. Your numbers, your percentage of completion numbers are gonna be no better than the underlying estimates. And let me tell you a story. I had a company when I worked at the bank, They were in the business of, what they call it? Asbestos abatement. They went all over the country, taking old buildings that had asbestos in them and getting the asbestos out. I mean, they would tear out the ceilings, they'd tear out between the walls, wherever the asbestos was, they'd rip it all out. Go in there in space suits looking things, because you can't breathe that mess. And they would eradicate it, they'd get rid of it. And they made a lot of money. Can you imagine signing a contract in Denver, Colorado to ship 50 of your employees, and they're gonna have to stay somewhere for 2 months while you do the work? And you still gotta make money on the project, right? So they were making a lot of money.
And they're working in a hazardous condition.
Yeah.
Hazmat pay is
Oh,
really
yeah.
good.
They were making.
Okay, so they're but think about it. Every time they left a job, what were they doing? They were slowly putting themselves out of business. Because asbestos has been outlawed for years. Nobody's building new buildings with asbestos in it. So every time they should have gone back to the office and said, well, another one bites the dust. So we're slowly but surely, when we get down here, we're out of business, we gotta quit. So what they said is, we tear out the ceiling, we tear out the walls, and we leave the place looking like it's just been bombed. And then other contractors come in behind us and put the walls back up, the ceilings back up, paint everything, and now it looks pretty again. Well, if we can remove asbestos, don't you think we can hang sheetrock? So they got the idea that they would start doing general construction too. They would rip the place apart and then they put it back together for you. Okay? So their contracts were asbestos abatement and general construction. So they would bid, and of course, because if I own the building, first of all, I want you to bid to get rid of the asbestos. And I'm gonna get other asbestos abatement companies to bid too, and I'll decide who wins. And then I'm gonna ask for bids from general contracting companies to put everything back in shape to my specifications, and I'm gonna decide then. So you had to bid 2 different contracts. It turns out they were really good at estimating how profitable asbestos abatement was going to be for them. I looked at their listen. The first time a contract shows up in the notes, it shows up in something called Schedule of Jobs in Progress. Okay? And you look at that contract number, AA, whatever, and then once that job is completed, it shows up in Schedule of Jobs Completed during the year schedule. And you would go find what the actual gross profit was. They were about 97 to 98% accurate on asbestos abatement. They had it down to a science. They knew exactly what it was going to cost them. I mean, 1 to 2%, hey, that's not even no sneeze there. But the general construction, they were about 50 to 55% accurate. And see, what happened is, number one, there was 2 people on the company. They had been really profitable for all those years. Then they decided to get into the general construction side too. And then one of the partners divorced. And so now he's having to borrow money against his interest in the company to buy the wife out, to make her go away. And so that's probably, I don't know, that might be something that pushed them in the general construction side. But then, all of a sudden, the company starts being a whole lot less profitable than it used to be. Revenues have gone way up. Because now we're doing asbestos and the general construction. But we're less profitable than we were $20 million of revenue ago. And the loan officer comes to me and is like, what is going on with this company? I don't understand it. And so we start digging. And so what we did is we would find a contract the first time it shows up in jobs in progress report, and then follow it all the way through to jobs completed during the year. And we would compare the gross profit, the initial gross profit, with the actual gross profit. And this is how we came up with this, and then we would do this. And we found out very quickly, they don't know what they're doing when it comes to general construction. They do not know how to bid a job in general construction. Now, this is a big deal because I've got another example. A guy was a commercial painting contractor. Go in and paint buildings. You know, you build a building and then you want somebody to come in and do all the painting. He could come in and do it, had it down to a science. Well, they got a call one day from a ship company saying, we want you to come down here and consider painting the inside hull of a ship. And they said, we don't know nothing about painting no ship. And they said, well, it's just like a wall. Just don't think of it as being a ship. It's just a wall. You're down there, I mean, you gotta use special grade varnish or whatever they call it for this because it's in the water all the time. But it's just space that you're gonna be painting. Oh, okay. So sent down his estimator to go down and look at it. The estimator takes out his tape measure, measures everything, finds out exactly what they want put on the wall, how many applications, finds out exactly what the material is going to cost them, and they bid. And they get the contract. And they lose $100,000 on the contract. They don't make anything. It cost them $100,000 more to do it than the revenues they got from it. You know why?
Because painting a ship's different than painting walls.
Or like, it's hard.
He measured from bow to stern this way, but he didn't double it. He forgot about the other wall. So he bid based on labor hours, materials, everything else for one side. But of course, they didn't want a half-painted hull. They wanted the whole thing painted.
When do you realize they did that?
Too late. And the guy, now listen though, the guy had a heart attack. The estimator, who had been with this man for 30 years, now you'll never be able to know if it was because of this, but he felt so bad that he had cost his boss, his close friend, this person he'd worked with for 30 to 35 years, $100,000. But the owner of the company said, but you've made me hundreds of times that over the years. So don't worry about this. I've made more than $100,000. I can handle this. But he was so stressed out, he had a heart attack and wound up, his health got so bad he had to retire. But the point of this is, you've got to know what your costs are going to be. You've got to be in a position to be able to estimate what your costs are going to be, because ultimately you're going to recognize revenues and construction cost to get your gross profit. Well, if you're not good at estimating the construction cost, you think it's going to cost you $10 million and it costs you $20 million, then you're not going to be very profitable. Unless you just say, okay, I estimate my cost of $10 million, so I'm going to bid $100 million because I know I'm not very good at it. You're probably not going to get very many contracts if you just bid like that, but you would be profitable if you got it. But you better believe the shipping company, did they know something was wrong with their bid? Of course they did. Because they had that bid, and then they had ever how many other bids, and these were all bunched together around 400,000 or 500,000 or whatever, and then you got this one down here. They knew something was wrong, but they also knew I'm signing a contract, and that contract says they got a performer, I'm gonna sue them. That's why some companies do cost plus contracts. But then think about it. Do you want somebody to build your house at cost plus? Do they have any incentive to keep the cost down? No, they have every incentive to drive the cost up, right? That's why, I mean, if you're somebody like, for example, Austell, we had a former student a few years ago, graduated with a degree in accounting, and he went to work at Austell. A few months later, they started laying off a bunch of people, and he was one of them, because they had bid on some contracts and lost them. And so now they work that they had counted on, that they had built up a workforce for and thought they were going to get, they did not get. And so they terminated him and a bunch of other people at the same time. And he decided to take 6 months off and not even look for a job, just pass the CPA exam. Because he thought, that'll make me more marketable once I get the CPA credential. And that's what he did. He took 6 months, he passed the exam, and he went back in the market and got a job from somebody who was looking for a CPA. But those kinds of businesses that are dependent upon contracts can be hit and miss. If military spending is really good, Austell's gonna be probably doing pretty good because they're gonna get their share of it. But if the next president comes in and says, we're gonna cut military and we're gonna spend more on social programs, then all of a sudden Austell might not very many people be working at Austell. But our point from the accounting standpoint is we've got to do the accounting for long-term, now this is all I'm talking about, long-term construction projects. Meaning something like that takes parts of 3 different calendar years to build. If you're talking about a contract that can be started and ended in a month, we don't need to worry about that. We'll just wait till the end of the month when it's finished and then recognize the revenue. But if we recognize nothing in year 1, nothing in year 2, and everything in year 3, that's gonna be crazy. We're gonna have wild swings in our profitability that are not indicative of what we actually are doing. So, with that in mind, look on page 1040. Page 1040, get it? If I were to open an accounting practice, I would be located at 1040 Sum Street. I mean, 18-33. During 2017, Nielsen Company started a construction job with a contract price of $1.6 million. So that's what we're going to be paid to build it. The job was completed in 2019 and the following information is available. Okay, top of the next page. Cost incurred to date, estimated cost to complete. Billings to date, that means how much have you sent them a bill for, and how much have they paid you, collections to date. A says, compute the amount of gross profit to be recognized each year, assuming the percentage of completion method is used. Now B we're going to skip because we don't have time to do the journal entries, but C says, compute the amount of gross profit to be recognized each year, assuming the completed contract method is used. You have to use the percentage of completion method if you are in a position to reasonably estimate your percentage of progress. But if you say, I'm not good at that, I can't do that, then you have to default to completed contract, which would show 0 revenues, 30 million in revenues. So you can see the FASB clearly prefers that you show it as you make progress, that you only have to default to the completed contract method in a worst case scenario. Okay. You have to do these problems in steps. if I were in this class, I would have a note card, and I would say percentage of completion, step 1. Determine the overall contract status at year end. Determine the overall contract status at year end. Okay, wasn't it 1,000,009?
6.
Crap. $1,006,000. Okay, minus estimated construction cost. Because they're estimates. I mean, we don't know to the penny how well this is gonna be. Okay, now look at the material in the book. At the end of 17, you have incurred cost of $400,000 and estimated cost to complete $600,000. Therefore, your latest estimate is cost of $1 million, right? 400 plus 600 is the million. So, my estimated gross profit at the end of this year is $600,000. Does that make sense? All right, now, step 2. Write this down. Determine the percentage complete on each year end. Determine the percentage complete on each year end. Cost incurred to date divided by latest estimate of total cost. Cost incurred to date divided by the latest estimate of total cost. What was this? 400,000 divided by 1,000,000? So at the end of this year, we're 40% through, right? Cost incurred to date, 400,000. What is your estimated total cost? 1,000,000. So 400,000 as a percentage of 1,000,000 is 40%. Okay? Number 3. Calculate the income statement data for the year. Calculate the income statement data for the year. Okay? So I'm going to do long-term construction revenue minus construction expenses equals gross profit. Okay, now, please pay attention. This is an estimate up here. This is what you think you're gonna make on the overall contract. This is the gross profit you're recognizing this year. Okay, now watch this. We take the 40% and multiply by 1,006,000. 4 and 6, 24, 4 carry 2, 640. What are the actual costs that you've incurred this year? 400,000. So what gross profit should you recognize this year? 240. watch this. Is that also 40% of 600,000? Isn't that 240? Yes. So the answer to the question is, or the answer to the question is, how much gross profit should be recognized in each year? 2017, we recognized 240,000. Okay, now watch this. I'm gonna suggest that you add a row for cumulative gross profit. So the cumulative gross profit we have recognized on this contract is 240. Okay, Ms. Jones, in year 2, look at your data on the top of the right page, what are costs incurred to date at the end of 18?
825,000.
825, and what are the costs yet to be incurred?
It's 275,
So that's $1.1 million.
Mhm.
All right, so now we think we're only gonna make on the contract $500,000. Last year we thought at this point we were gonna make 600 on this contract. But now our costs have been revised upward, and so now we don't think we're gonna be as profitable. Okay? What are the costs incurred to date, Ms. Jones? At the end of 18?
What's that, 825?
825, well, the cost incurred to date, you're the one looking at the
Yeah, that's
book.
what I'm like.
Divided by total estimated cost, $1.1 million. What's 825 divided by $1.1 million? 75? Okay? So now, let's do step 3. Get your income statement data for the current year. Now watch this though, be very careful. Multiply $1.6 million times 0.75. But realize you did some of that work this year and you did some of that work last year, so subtract 640. And how much revenue should you recognize this year?
560.
560. Thank you.
So could you just multiply by the percentage
No.
difference right there? Okay.
No,
Okay.
don't get in that habit, no, because you'll get in trouble if you do that. Later, I'll show you. Okay, what were the construction, Ms. Jones and everybody else, look at the data. What were the construction expenses that were incurred in 2018?
The cost?
540.
Yes.
825.
No,
425.
that's cost incurred to date. That means since the beginning of time. How much was incurred this year? 425. Right? If 825 is at the end of year 2 and 400 was at the end of year 1, it's 425. So what is my gross profit that I should recognize in year 18? $35? No, 135. All right, now add 240 and 135, 375. Are you with me? No?
No.
Okay, you gotta spend some time looking
I
at
will.
this.
But I can't-
All right,
I can't move that.
now we go to Mr. Bland, the last year. Now the thing is finished. What are the costs that were incurred, what are the total costs as of the end of 19? $1,070,000. So we wound up making $530,000 overall on the contract, right? And we're 1,070,000 divided by 1,070,000, or you don't even have to do this. I mean, you know you're 100% through in the year that's finished. So now multiply 100% times 1,006,000, and that'd be 1,006,000, and then subtract 560 and subtract 640. And what are you left with as revenue to recognize this year? 400? Okay, if the cost incurred to date at the end of this last year was 1,070,000, and the cost incurred to date last year at this same time was 825, how much would the cost that you incurred this year? 245. So this would mean that you should recognize 155,000 in gross profit in the third year. All right, now watch this. 5 and 5 is 0. Carry 1. 8 and 5 is 13. 3. Carry 1. 3, 4, 5. Does that 530 match that 530? Yes. Then we double checked and now I know I'm right. Questions?
Where'd the 400 come from? Just the calculation.
Where did the what?
400
I don't see
for
for
long-term cost.
2019 long-term.
the revenues. Well, we took 100% of 1,006,000, and then we subtracted these revenues that we recognized last year and these revenues that we recognized in year 1, leaving us with whatever we should recognize in year 3. And watch this. What's 100% of 530? 530. Subtract the 135 you recognized last year and subtract the 240 you recognized in year 1. What are you left with? The numbers all fit together nicely. Step 1, determine the overall contract status at year end. Step 2, determine the percentage complete at year end. Step 3, calculate the income statement data for each year. So the answers are 240, 135, and 155 for A, percentage of completion. What would the answers be for the completed contract method? 17, 0. 18, 0. 19, 530. All of it, right? I got to recognize all 530 in the last year. Questions? This is called percentage of completion accounting versus completed cost. Completed contract. Okay? So, for Tuesday, I want you to attempt problem 9 and problem 11. I'm going to meet you at the door, and you don't get in if you don't have these two completed. They don't have to be right, but they got to be completed. And bring your chapter 19 material to class with you on Tuesday, because we're going to go on into chapter. I think chapter 19 is the hardest chapter in the book, but students think it's statement of cash flows. I had the hardest time with deferred income taxes, which is chapter 19. All right, so we will cover problems 9 and 11 on Tuesday, and then we go right on into chapter 19. All right, thank you for coming. Have a good weekend. Stay out of trouble.
You made it 83. Yeah, that's how much points you have right now.
Then I have the homework and stuff too. I had taken up some homework, so I want to do the actual calculation.
Minus.
You know what I'm saying? I mean,
You need a 9.
I'm gonna confirm that. Not that I don't believe him, but I just want to like hear from him.
You too, sir. See you on Tuesday.
See what you need.
Whoever's the last person, when you try the lights and close the door.
Just watch come with me. See what you need.
I don't know what I need.
What?
180 or 7 needs to go. 69.9. I'll go for 30.
Go for a B in the class.
No, that's not possible. I'll need 100 on the final.
It is possible. There's curve.
So you're right.
If you actually study, like, it's not hard.